While the day started with a lot of promise as we saw the S&P 500 come within 1% of all-time highs, and we saw a healthy rotation of money moving from growth stocks into value stocks, we did see a very ugly end to the trading session here today where all four of our key U.S. equity indices closed lower. The S&P 500 actually had its first down day in the last 8 trading sessions. We were led lower by the NASDAQ composite once again. A lot of those high-flying tech stocks have really been stumbling the last 3 sessions. But when we look at all of the trends, they are largely still intact. In fact, we have a lot of bullish intermediate confirmation signals that we'll discuss in tonight's video, in addition to getting into our trade application example, where I wanted to focus on a very hot area of the market up until today, which could be setting up for some bounce potential. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's August 11th, 2020. First of all, if you're brand new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, and then go to our description area to make sure you're signed up for our email distribution list. In addition to that, we're heavy users of Twitter. I'd encourage you to follow me. My handle is @BrandonVanZ, and we certainly appreciate those of you that click like and retweet on these Market Outlook related tweets. And lastly, we do have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's jump into our charts here. And as you can see, it was a down session across the board. The S&P 500 was down 0.8%, so that's what that candle looked like there. It's a pretty aggressive candle, and it was the first down candle in the last 7 sessions. Well, I should say 8 sessions technically. There were 7 up days in a row, and then we ended here on the 8th day to the downside for the S&P 500, and we came oh so close to hitting a new all-time high earlier in the day. If I were to show you the longer term chart, this is a 3-month chart we're looking at by default, but let me go over here to a 6-month chart and show you how close we were to an all-time high this morning. The all-time high in the S&P 500 was 33.93, and at the high of today's session we got up to 33.81. So we were just 12 points away from an all-time high that would have completely erased everything that happened with the coronavirus there back in the spring. Back on track here with the 3-month view, I did want to point out that with today's pullback we have what's known as a bullish intermediate confirmation signal. Now keep in mind that exists when we have a bullish intermediate posture to start with, and that can happen in one of 2 ways. Either the green line is heading up between 20 and 80 on that technical indicator, like it was back here in early July, or the green line can just merely be in the upper reversal zone regardless of what direction it's going, which is the case right now. You can see the intermediate line's reading in this label here is 97. Even though it's falling, we still consider that to be strongly bullish, and the trend is clearly intact for the bulls at this moment in time. So that's one thing that we need to identify for the bullish intermediate confirmation signal. The next thing we need to identify is if the red line is in the lower reversal zone. Now that one just can't simply be falling between 80 and 20. That part of that signal requires that the red line has to be in the lower reversal zone, and that is the case here as of today's close. You can see the S&P 500 momentum / red line closed at 11.53. So that's a nice healthy spot for it to be. Now, sometimes you've heard David and I discuss the idea of ideal setups versus less ideal setups. This one would be considered a less ideal setup because the blue line isn't quite below 50. Now, although technically the blue line is not officially part of the bullish intermediate confirmation signal, we've noticed that if the blue line is between 20 and 50, while you have that bullish intermediate confirmation signal, the resulting success is a little bit better. It's kind of the idea of letting the market breathe out and exhale a little bit longer. Remember that the bullish intermediate confirmation signal is a buy the dip strategy. And yes, we did get a dip today of 0.8%, but some might think that they want a little bit more of a dip before they get too aggressive with it. Now remember, the idea here is not that you're going to get this major dip way down here to 2,800 or something along those lines. The idea is to buy a dip within an uptrend. So if the stock or if the market were to fall to 2,800, which is entirely possible, most trend traders wouldn't want to buy that dip because the trend would be broken. So the idea is a little dip, not a major dip. So that way you're buying after a pullback in price, even though the majority intermediate trend continues to be to the upside. So we do have bullish intermediate confirmation signals on all four of our charts here today. You can see the Dow Jones just barely got there with the momentum line just barely below 20. It was at 19.68, but technically that qualifies. The one I wanted to point out and address here a little bit more thoroughly is the NASDAQ composite. You can see this is actually our third straight day for the NASDAQ to the downside. It's been pretty clear to those that are paying attention. And again, another reason, hopefully you're following both David and I on Twitter. This is something that I pointed out yesterday as well, this rotation from growth stocks into value stocks. And where you're going to see that is kind of here in the NASDAQ first and foremost. 3 straight days to the downside for the NASDAQ, even though the S&P 500 has gone up 7 days in a row up until today. So there's a little divergence that was taking place there. So in other words, this so-called buy the dip signal of the bullish intermediate confirmation signal is considered maybe a little bit more ideal because you've had a bit more of an exhale. Right? You've had 3 full days of sell-off here, so it's a little bit more of an exaggerated dip from that recent high. You can see that the blue line is between 50 and 20. Maybe it's a little bit low down there at about 24, but still in a better place. And if you look at this trend and kind of try to flush out all of your, your baggage that you might have come into this situation with, thinking that, all growth stocks are going to go straight down from this point forward. And if you just looked at this chart, you would probably remind yourself that this is still a chart that is clearly in an uptrend. Yes, the last 3 days have been pretty aggressive sell-offs, but we haven't broken any support levels. In fact, we continue to trade above a rising 30-day moving average. So for those of you that might be a little bit more bold and have been waiting for a little bit of a pullback in some of those high-flying stocks, perhaps this signal here on the NASDAQ composite is worth paying attention to. It was the worst performer today, 1.7% to the downside, and just to make it official, the small cap Russell 2000 was down 0.6% to the downside, and the Dow Jones Industrial Average was today's best performer. It was still down, but only down 0.38%. The Dow was actually looking pretty promising early on. There were a number of names there like Raytheon and Boeing that were really leading the market higher as the industrials have really started to make a surge here recently. In fact, I'll point out now that I'm on the topic, come over here to the internet briefly and show you the sector selector rankings. Now remember, I put this together on Friday evenings with that previous week's worth of information as my input signals and deliver this to my premium and plus students on my Monday class here at Market Scholars for my top-down trend trading. And what we identified was that industrials had already roared to the #1 place even before this week's activity, where we've seen stocks like Caterpillar and Boeing and Raytheon, those types of companies, John Deere, all doing pretty well. In fact, some of you might have noticed UPS really soaring here recently as well. So all of those types of stocks have been assisting the industrials in quite the rapid ascent here recently. We also saw strength in the materials, which I would chalk up to benefiting from a falling US dollar in recent weeks and months, and then also a bit of strength there in discretionary. You'll notice that all 3 of those top areas, which is what we concentrate on in my Monday class, all rose in rankings this week, which means we had to make room for them by having other sectors fall. And worth noting is the intense fall of technology. Technology was ranked #2 just last week. It fell all the way down to #6. Now again, I need to stress that this was as of Friday night. I had no idea that the tech stocks were going to get annihilated yesterday on Monday and today on Tuesday. But this particular graphic was giving us that heads up that something was afoot. There was something brewing in terms of negative price behavior within the technology stocks even before this week started. So again, if that's something of value to you and you'd like to take advantage of that knowledge and information to place better trades, feel free to sign up to become a premium member of Market Scholars and see how I utilize this information in my top-down trend trading class every Monday morning. On the downside of the graphic, you did see energy and real estate as seller dwellers. You've also seen some negative momentum into the utility stocks here as well, and I think that continued on today, as I think utilities were one of the worst performers in today's market as well. Also, while I'm over here on the internet, I always like to say thank you to those of you that take the 5 seconds out of your day to click like for us over on Twitter whenever David and I post these market outlook related posts. Remember, we don't make money off of these videos. We do it to hopefully promote our business, where we do make money in our premium side of the business, but this does take us 2 or 3 hours to produce these free videos for you guys every day. So if you appreciate the effort that goes into them and you want to say thank you to us, the best way to do that is to click like for us there on Twitter. My goal is always to get the number of likes up and over 100. So I like to see them in the triple digits. You guys came through for me last time around with 116. My hat's off to each and every one of you. That encourages me to do these videos as often as possible. So keep up the good work on your end. Also, while we're over here, a friendly reminder that earlier today I taught my dividend growth investing class that has now been posted to the Trading Room's calendar. We did cover the financial space. Of particular note, we've been talking about the banks a little bit here recently and seeing some of them perk up in recent trading sessions. So if you're interested in seeing the head-to-head deep dive research that I do for my dividend growth investors, feel free to check out the trading room that I posted here earlier today if you're a premium or a plus member of Market Scholars. David taught his directional options strategies class as well. Tomorrow I'll be talking about factor-based swing trading. And just as a sneak peek, I don't want to spill the beans too much here, so I'm not going to show you the actual rankings because I want to reserve that for my premium students first thing in the morning. But I will tell you that on the factor selector, the number one and the worst factor, so the top and the worst factors, both got switched out as of the rankings for this week. The last time that happened was well over 3 months ago. So there was a major shakeup from a factor perspective that we witnessed this week, and I'll be getting into all of those details tomorrow morning for my factor-based swing trading class, and I hope to see many of you there. Let's get back on track with some more charts here and pop on over here to the 3 green arrows chart on the Thinkorswim platform. Here you can see we do have something new to report today, which is why we try to look at these charts on a daily basis if we can help it. And you can see here that the NASDAQ composite sold off enough today, where it was down 1.69%, that we got a red arrow on the MACD histogram. So it's the first of these major equity indices in the United States to no longer have a 3 green arrows setup. Now, just because we've got one red arrow doesn't mean that we must despair and the path forward is going to be horrible or anything along those lines. As always, we're going to keep our eyes on that on a day-by-day basis. And right now, what we know is that there hasn't been a lot of broken support levels. So for all I know, the NASDAQ could easily pop back up tomorrow based upon the bullish intermediate confirmation signal I just mentioned to you a moment ago. But it is worth noting that enough momentum has come out of the system that the MACD histogram has now triggered below the 0 line. And again, remember that the MACD is used to judge the momentum of the market, and with the last 3 days selling off there in the NASDAQ, it's not a huge surprise to see the momentum leaving from that indicator as well, whereas we have not sold off for the last 3 days in the other 3 equity indices, and that's why all 3 of those continue to retain their 3 green arrows setups at this moment in time. The good news is, as you look at all these charts, they're still all in significant uptrends. If we were to take a look at kind of a longer term view now and look at our 1040 crossover method, this will be chart 4C for those of you that are premium members following along at home. Remember, all of our premium members get access to the 50 plus charts that David and I use in our presentations and our classes that we teach over at Market Scholar. So make sure you're taking advantage of that. There's hundreds of hours worth of development that went into all of those various customized charts. Anyway, here on 4C, you can see our 1040 crossover method. And as I mentioned to you guys last week when I was last with you, the Russell 2000 at that time, now this was Thursday that I was last with you, was giving us a bullish crossover. And I said, as long as we don't have some sort of a major meltdown on Friday, it should be locked in. And indeed, that is the case. We locked in the bullish crossover there. Some of you might refer to it as a golden cross. And importantly, it was the fourth and final of these four charts to produce that particular signal. Remember, up until this point, the Russell 2000 had been a lagging index, although it's caught up in a hurry. So that kind of completes the grand slam there. We've got the S&P 500 that gave us the golden crossover back in the first week of June. We had the Dow Jones Industrial Average that gave us the golden crossover on July 20th. The NASDAQ composite, of course, was early in its promise to lead us back to the promised land. It gave us the crossover way back in the first week of May, and now just last week we finally got the completed series there, as it were, with the Russell 2000. So that's a promising sign. Remember, sometimes longer-term investors are going to be using these types of charts. Remember that when we're talking about a 40-week moving average, that's equivalent to a 200-day moving average with that blue line. And when we're talking about a 10-week moving average, that's equivalent to a 50-day moving average with that orange line there. So we have seen that sensitivity tick higher with the shorter term moving average now up and over the less sensitive longer term moving average, which is generally perceived bullishly for those that are looking for strong trends within the marketplace. Let's now get into our 12 grid analysis, starting with chart 5A on the asset class side of the equation. Now, the one thing I wanted to point out, many of you probably noticed this because we've been talking about this particular trend for quite some time, gold got annihilated today. GLD was down over 5% here today. GLD ended just a hair under $180 per share. And you can see the major gap down that took place from a candle perspective there. Now, what's a little bit odd about this situation, considering the sharp drop-off from just 4 days ago with GLD, is the fact that the background color of the chart is still green. And that reminds us that this thing had so much positive and bullish momentum behind it that it probably became a bit overheated, because now that it has, quote unquote, melted down like it did today, it's still above a rising 30-day moving average, and it still has a strongly bullish intermediate posture according to the market forecast technical indicator. Now remember, right now we actually have an open trade going for a gold-related investment in this presentation. So if I were to come over here to the Monitor tab, first of all, I wanted to also point out that the trade I did just 1 week ago, that swing trade on U.S. foods, locked in our gains here today at 24.94. I wish they all worked out that way, where we're in and out within 1 week's worth of time. So for those of you that followed along with that particular trade in your paper money accounts, congratulations. You should have been closing that down here today at max gain. Anyway, what I wanted to point out over here is that the only open gold-related trade that we currently have is GDXJ. Now, remember, this was a trade that we had put on quite a long time ago. If I were to click on the View Trades right here, it will show us that we placed that trade way back on July 1st. We're still making money on that trade, and I really am not overly fearful on that trade. What we did in that particular case was we sold a bull-put spread. And remember that we simply need the stock in question to stay above the sold strike price. In this case, we sold the 43 put. So with this particular ETF trading at 55 right now, despite getting hammered to the tune of 9% today, like a lot of other gold mining companies, this thing got absolutely hammered today. But because it had gone up so much, I'm still not sweating bullets on this one at all. We only have 10 days left in this trade, and we have a $12 per share margin of safety, right? We just want to make sure that this particular junior gold mining ETF does not fall from a current price of $55 down below 43 bucks in the next 10 days. So again, remember, we got into that trade on July 1st. If we were to come back over here and look at where it was gold on July 1st when we placed that trade, it would have been right here that I'm kind of circling on the chart. And you can see it has gone on an epic run from that point forward. Now, as I watched gold go up week in and week out ever since placing that trade, I kept on kicking myself that I wasn't presenting more bullish gold trades along the way, but I was fearful for a day like this. And a day like this came probably later than I assumed that it would, but I figured there would be some give back to a trend. There typically is. You know, stocks and ETFs don't just go straight up. So we are in that give back period. The question is, where will we stabilize? And when we do stabilize, if we do, will there be further bullish opportunities there? And I think there very well may be. And I'm going to get into that a little bit later in tonight's video with our trade application example. So we'll stick a pin in that concept. Let's talk about some of these other charts now. I should point out that the US dollar did rise today, so perhaps that was part of the reason that we did see a little bit of difficulty in the commodity markets. It wasn't just gold that fell today. Oil also fell here today. We did see that the foreign developed markets did close higher today, so they beat both the US stocks and their emerging markets counterparts from that perspective today. Emerging markets were down 0.27%. And as I mentioned before, the S&P 500 was down about 0.83% in that case. But you can see that in all three of those charts cases up there at the top, we do have bullish postures, or dark green background charts. And I'm referring to the first three on the board. Yes, you technically have the preferred stocks over here to the right-hand side with a bullish posture as well, but preferred stocks don't really line up all the time with the common stock universe that we tend to focus on here in this video. So anyway, kind of interesting to see that movement with the developed foreign stocks taking a leadership role here today. We did see quite the ugly sell-off in high-yield bonds. Take a look at that candle there, kind of in the middle rung, and that's one of the most aggressive candles that we've seen, probably since going back here to July 13th. So we gave back several days, if not a few weeks worth of price behavior there on high yield bonds here today. Also, I haven't mentioned it yet, but I did just catch here a moment ago that Joe Biden did select his vice presidential candidate, Kamala Harris, and I do believe that the futures were trading up just a little bit. You can kind of see that up here. I know it's hard for those of you that watch this on a smartphone, so I'll just let you know that the bid on the S&P 500 right now is 333.73. So in other words, it's higher than where our closing price was here today. So maybe the market is a little bit comfortable with that vice presidential pick and is thankful that it didn't go in some other direction that would kind of spoil the party for stocks. Anyway, let's go ahead and take a look here at the U.S. Treasury yield before we move on, because this was an epic day. You can see that we were up 14% on the 10-year U.S. Treasury yield. Now, usually you don't refer to that in percentages because it itself is a percentage, but just wanted to stress that that is a major move compared to what we had been seeing with Treasury yields recently. You can see the size of that candle is on top of the already gap up that already took place to kind of make it even more impactful there. So on a one-day basis, this is likely the biggest move we've seen higher in yield since going back here to the first week of June there. And I think that kind of plays into why the banks have been star performers here this week. You can see Treasury yields have actually gone higher here the last 3 or 4 sessions, and it's no coincidence that the banks, who benefit from increased net interest margin when interest rates go higher, have also been outperforming the market during that span of time as well. So keep your eye on U.S. Treasury yields. If you think they're going to continue to go up, then the banks may be a very interesting place for you to get some exposure. And again, a reminder, we covered one of the highest quality banks today in my dividend growth investing class for those of you that are premium and plus members. If you want to hear my analysis on that particular company, it's over on our trading plans, or I'm sorry, our trading rooms tab on our website. All right, let's go ahead and take a look at another 12 grid here. In this case, we're going to go to the U.S. sectors 12 grid. This will be the market cap version. That's one thing I didn't point out when I was talking about the sector selector, but I should have. The sector selector is using an equal weighted approach. This particular group of 12 companies right here is a market cap weighted approach because of the way that these particular ETFs are constructed. So you will see slight nuances as a result of the two different ways of maybe looking at the market, whether it's market cap weighted or whether it's equal weighted. What I will tell you is that technology would not have fallen nearly as much as it did on my sector selector had I been using a market cap weighted approach. And what that's telling me is that Microsoft and Apple, as kind of the generals of the army, are still going out ahead of their army, trying to battle their enemy. But as they turn around, they notice that their army that they thought was supporting them had stopped supporting them and had halted in their tracks. Now, whether the army eventually decides to catch up to the generals or the generals retreat and go back to the army is anybody's guess. But it is worth pointing out because I don't often see that type of divergence take place. More times than not, you're going to find that the equal weight and the market cap weight are very much in unison with one another. This is one of those rare times where the market cap version of technology is vastly outperforming the equal weight version, and it is causing a big distortion in some of the rankings that I'm using in my sector selector. Anyway, as we look at today's activity, the worst performers were utilities, down just over 2%. Pretty ugly candle, as you can see right there. Now remember, when interest rates go up, utilities do poorly. Remember, there's kind of 3 major interest rate sensitive sectors out there. Utilities and real estate are interest rate sensitive in such a way that when interest rates go up, as they did today, as I mentioned a moment ago, they surged higher today. So utilities and REITs are interest rate sensitive to such a degree that they would likely be at the disadvantage. And you can see here that that was the case. Those were the worst 2 performers here today. Utilities down just over 2% and REITs down just under 2%. Now there's another interest rate sensitive category, but they actually benefit when interest rates go up, and that is the financials. And so again, no surprise to learn here that the financials were today's best performer out of our group of 11 sectors here. The financials actually finished higher by over 1% on a day when most of the rest of the stock market was getting, slapped around a little bit there. So very impressive relative strength there in the banks, brokers, insurance companies that benefit when interest rates rise. Now, if we take a step back from the shorter term nature of just looking at daily returns, you can see as you look at all of these charts here that we still have strong trends pretty much across the board. The background colors of all the charts are dark green, telling us that the intermediate term posture using that market forecast technical indicator is strongly bullish. So yes, there were some ugly sell-offs here today with the utilities and the REITs and even technology down nearly 1%, or nearly down 2%, I should say. But if you were to take a step back and look at the trends are still mostly intact with these securities. And so that is a more bullish sign than anything else there. All right, let's get into our trade application example for today. I'm going to come on over here, and we're just going to use chart 4A for this. So this will be our market forecast 1 grid view. And I wanted to pull up a chart that is oftentimes discussed right along with gold, and that is silver, of course, sometimes known as the poor man's gold. Silver got clobbered today. Silver was down 13% in one single session. That is a very ugly, ugly day. In fact, it's down even further after hours right now, as it was touching $23 even here just a moment ago. So we might have a little further selling to start the day tomorrow. But what caught my eye with silver was, first of all, knowing that I had regretted not taking more bullish trades in the precious metals space here since we placed our last trade there at the beginning of July, considering the massive run-up that has occurred. Well, easy come, easy go. You can see that with today's sell-off, silver is now back to its breakout zone. In other words, we had kind of this stalling out period of the chart here between the 27th of July and then this candle here on the 4th of August until we broke out. So this is known as a breakout retest that we're at right now. And I also wanted to identify that we have one of those more ideal bullish intermediate confirmation signals that exist on this chart of SLV, where we have a strongly bullish intermediate posture with the green line in the upper reversal zone, at the same time that we have a red momentum line below 20, in this case it's at 6, and we also have the blue line somewhere between 50 and 20. So we have a possible breakout retest where there's potential support sitting at the old breakout zone, in addition to a trade signal from the market forecast technical indicator here to assist us with placing a trade like this. Now, there are, of course, a variety of ways that you could go about placing a bullish trade, but I'm kind of feeling like I want to play it safe, which is probably more of my personality trait than anything else, so I wouldn't read too much into that. Those of you that want to be more aggressive with this, I think you have the green light to do it. But I also want to be accounting for the fact that we're kind of going into a choppier period of the year for the markets traditionally as we get into the end of August into September and October. And so I want to be mindful of that. I want to play it a little bit safer. And what I'm going to do in this case is I'm going to come over here to the September monthly contracts with 38 days until expiration. And I'm going to focus on, actually I need to give us a few more strikes here. So let's pull up 30 strikes. I'm going to focus on the $18 put here. What I traditionally seek out is a 1% return on risk when I'm selling puts. So the $18 strike on SLV currently has a bid of 18 cents, an ask of 20 cents. The last traded price was 18 cents, and as I mentioned, it's actually down a little bit after hours here tonight, so if that continues into tomorrow morning, we might actually get filled at slightly more than a 1% return on risk on this one. But remember, what we are effectively doing when we're selling a put is we are committing to the idea of being willing to buy that security, 100 shares for every contract that you sell, at the strike price. So in other words, this $23 investment right now, we have to be willing to buy 100 shares of it at $18 for every contract that we sell. If we look at the chart, I will show you that 18 is way down here. Right? Some of you are going to be maybe more aggressive and buy silver right now off of this prior breakout base area, but you'll notice that 18 would take us all the way back to this prior base over here from the middle of July. So for some of you, that might feel like, you know what, you just missed it. You were watching silver, but you decided not to take the trade right there, and then the next thing you know, it's gone on a blistering pace. It's gone from 18 to 27 in a heartbeat. Some of you don't feel comfortable chasing securities like this. By selling a put, it gives you that opportunity to take in some profit and conduct a bullish trade by taking you back in time to that original breakout zone, in this case way back here at 18. So it'd almost be like reversing the clock all the way to July 17th if you were forced to buy it. And remember, you're only going to be forced to buy it if it comes way down and trades below 18 during that time. If it stays up here at 23 or drifts a little lower or a little bit higher in the next 38 days until the September expiration, you're likely not going to be buying those shares at $18. Instead, you get to keep the premium that you take in here at the beginning of the trade. So let's go ahead and place that trade by clicking on the bid price. In this case, since it's a lower price security, I'll do 10 contracts rather than just the default one that I traditionally do during these educational broadcasts here. But in this case, I'll be willing to buy 1,000 shares rather than just 100 shares if it does get all the way back down to 18. And I'm going to take in some premium up front. I will just put it in as a day order. Actually, you know what? I'm going to change that to good till cancel. Just in case it pops for some reason tomorrow, I'll be willing to take that trade even beyond tomorrow if it so allows me to. But I'm going to click on confirm and send. And remember, I'm going to take in $180 in cash for my willingness to buy 1,000 shares of silver at $18 if it does fall from 23 all the way down to 18 in the next 38 days. So let's go ahead and send that in and see if we can get filled first thing in the morning. Thank you so much for joining me here in this presentation. Remember, if you got value out of my analysis of the markets and learned a few things, or at least was able to alert you on a few trends, the one way you can thank me for that is by clicking like on Twitter. It only takes you 5 seconds, even though it takes us a couple of hours to put these videos together. So I think you got a pretty good trade-off there. We certainly appreciate that as it helps us promote our fledgling business here to a much wider audience than we would be able to on our own. So tomorrow I'll be back in action with my factor-based swing trading class for those of you that are premium and plus members in the morning. And then David will be teaching his options inventory class a little bit midday tomorrow. And then tomorrow David will be back with you here in this free YouTube video for the market outlook. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.